Let's shift gears now to the macro economy. We got weekly jobless claims this morning totaling 238,000. That was fewer than expected. This coming before the big January jobs report tomorrow morning. So for more on this, let's bring in Dan Eye, Pitt Capital Group CFA and CIO. Dan, great to talk to you this afternoon. Just thoughts on your expectations for that big jobs report tomorrow. You know, the ADP report, pretty ominous bellwether we got yesterday with a contraction of over 300,000 in the month. What are you expecting?
Yeah, thanks for having me. I think expectations have certainly changed after the ADP report yesterday. Consensus is for an addition of 175,000 jobs. It looks like we'll see something with a negative print tomorrow, but I think it is really related to the Omicron situation in December and the carryover to January. So I don't think it necessarily will speak to the strength of the health of the labor market for the first quarter and for the rest of the year.
Dan, when we're looking at the market action today, it sort of begs the question again about whether it is the earnings that's going to be driving the action moving forward, or if it really comes down to some of that economic data you just pointed to, specifically on something like these high growth names, the tech names. Do you see more downside to come just because of the uncertainty, not necessarily within the sector, but outside of it? How do you look at the swings we've been watching?
Well, I think in our view, it's just a situation where the market needs some time to really adjust to the new reality of tighter monetary policy and dramatically lower fiscal stimulus. So we're really expecting to see a continuation of volatility throughout the year and more back and forth as investors really grapple with on one hand tighter Fed policy, and on the other still very healthy economic and corporate earnings growth. I think from our seat, though, we're excited because we see a very wide valuation dispersion gap in the market. So some stocks are extremely expensive and probably shouldn't be, and some stocks are extremely cheap and probably shouldn't be as well. So we just think that it sets up for a really good environment for fundamental stock pickers like us.
Dan, I want to ask you just kind of about the rotation broadly in assets. I mean, today we're seeing red across the board in equities, but then you also have the 10-year up 6 basis points to 183. We've seen a rip up also in the 30-year 6 basis points, which tells me that there's still a lot of pricing going around the Fed that might not be translating necessarily in full to other asset classes as well. How does that kind of form your investment thesis through that volatility?
Yeah, I think, we expect to see a continuation of interest rates grinding higher from here, but it looks like the velocity of those interest rate increases have kind of leveled off a bit over the last, week and a half or so. And I think that has, contributed to the pretty strong snapback rally that we've seen over the last, week and a half or so. But, other than that, I think maybe makes some short-term corporate bonds look a little bit more attractive. But we do think that there's some room for, especially the longer end of the yield curve, to grind a bit higher over the coming weeks.
Dan Eye, Pitt Capital Group, joining us there. Appreciate your time today.